Last month's US Nonfarm Payrolls report shocked the markets with unexpectedly strong job growth. The upbeat data crushed any hopes for a July Fed rate cut and cast doubt on whether we'll see 3 cuts this year. The surprise has sent shockwaves through the Forex, commodities, and stock markets and created huge trading opportunities. So, what's next for the Fed's monetary policy? And where could the markets be heading next? This month's NFP could be a key in understanding the strength of the US economy and how the Fed might respond. Mark your calendar as the report drops on August 1st at 3:30 p.m. GMT3. Stick around until the end of the video for expert predictions on the NFP and key trading opportunities to watch. And before we dive in, don't forget to hit subscribe and turn on notifications so you never miss our latest trading insights. In June, the Nonfarm Payrolls report beat expectations once again, with 147,000 new jobs added. On the other hand, the unemployment rate has dropped to 4.1%, down from 4.2% last month. However, wage growth came in slightly softer than expectations, with average hourly earnings rising 0.2% month-over-month and 3.7% year-over-year. The upbeat job data started a significant volatility in the market. The US dollar index briefly recovered from a multi-day losing streak but later dropped below the 97 level amid renewed uncertainty over Trump's tariff policy. On the other hand, gold prices dipped immediately after the data release, while the 3 major US stock indexes were pushed higher. Meanwhile, oil prices were pressured due to the weakening oil demand driven by the solid job growth which eased the Fed rate cut expectations. To trade around the NFP release, it's crucial to watch the forecast numbers. These can give you a solid idea of the major market moves ahead in Forex, commodities, and stocks. In July, the non-farm payrolls are expected to rise by 147,000, while the unemployment rate is forecasted to remain at 4.1%. On the other hand, the wage growth is also expected to remain unchanged, with average hourly earnings projected to rise by 0.2% month-over-month and 3.7% year-over-year. Now, let's break down the potential trading opportunities for 3 key assets that could experience high volatility. Stay with us until the end for some exciting trading ideas. Let's start with the US dollar index. The dollar rebounded on Monday as trade war concerns eased. From a technical perspective, both momentum and RSI indicators are flat, which suggests potential for two-way movements. If upcoming jobs data beats expectations, the dollar may push toward resistance levels at 98.97 and 99.42. On the flip side, if the report falls short, support levels at 97.55 and 97.10 could be tested. Moving on to gold. Gold prices slipped following the US-EU trade agreement, a strengthening dollar and rising US Treasury yields. If the jobs report strengthens the dollar further, gold could dip toward key support levels at $3,245 and $3,230. For gold to recover, it needs to climb back above $3,374, opening the path to $3,389 and beyond, especially if job data turns out softer than expected. Lastly, let's look at the S&P 500. The index recently closed at new record highs. Though enthusiasm around the US-EU deal is starting to fade, the broader trend remains bullish, supported by expectations of a Fed rate cut and strong corporate earnings. However, if a stronger jobs report pressures the stock market, traders should watch for pullbacks towards 6,357 and 6,319. For the index to continue upward, it must break through the 6,423 level, with potential to reach 6,452 and higher, depending on how soft the employment data is. The above recommendations are only for your reference and should not be considered trading advice. If you find this video helpful, let us know below and remember to like and share. Don't forget to click the subscribe and notification buttons to keep up with the market updates. See you next month.